It's the Market Watch. Here we talk about issues around the market, from the capital market, the NGX. We look at the equities market and everything happening around monetary policy and even sometimes investment. Because today we're talking about the All Share Index, 0.86% as at Monday. And how is the market performing? We're seeing it added 0.12% as well on Tuesday. We're moving on. We're also going to be moving on to FCMB. There's a public offer. 16, not 15, not 14, not 13, but 16 billion ordinary shares is out. 10 naira per share. You're going to find out on this episode of Market Watch. And then bonds are out. 2 years, 3 years bond offer. What is the yield? It started on the 6th of October and then ending on the 10th of October 2025. This is Market Watch, brought to you by Nigerian Television. My name is Frank, and I've got amazing gentlemen. I love your suit.
Thank you.
It's gray suit. So good.
Thank you. I'm different.
You're ready for the market.
Yes, I'm different from both of you.
Idika, you're very much welcome again.
Yeah, Frank, thank you. Thank you very much. Thank you very much.
All Share Index, 0.86% on Monday, 0.12% on Tuesday. And the market is starting on a bullish move. What's your take? 91 trillion naira as regards the market capitalization. What factors are driving this bullish momentum in the market?
Well, you know me, I'm not a fan of All Share Index. You know, you should always know that. I'm not a fan of All Share Index. I'm a fan of what my portfolio is doing. Yes, All Share Index can be going up and my portfolio is suffering. So what benefit do I have? But it's good for investors to look at the All Share Index to compare by other instruments averagely. And if you look at that, the All Share Index have done about 40%. It's huge. Beat inflation, whether you go back to inflation before rebasing or inflation after rebasing.
It beat both.
It beat both. So definitely, I think a good thing happening in the market. Sentiment driving that is people are still seeing strong fundamentals in some of the stocks, especially the consumer goods stocks, the consumer goods stock, especially then the ICT space. There's still a lot of value there. And then the financial sector, there's still a lot of value in the tier 2 banks and even the tier 1 banks. When you look at where some are, where others are, they might be just that closing of the gap. So there's still a lot of opportunity in the market when you look at. So that's what I'm thinking is happening now. That's not what I'm thinking. That's what is happening now.
Yeah.
You see investors doing portfolio reshuffling. You see investors moving, and then you see investors taking position. Don't forget, October is always a very interesting month in the equity market because the third quarter results normally come in there. That will now pitch investors into expectation for the last quarter of the year and also dividend payment. And so that has been the tradition. So it's always a very interesting month. So I'm not surprised what is happening now because a lot of people are keen in the consumer goods. Remember, last year, a lot of investors did not enjoy any dividend payout from them because of the floating of the currency, the kind of losses, and they have come out of those losses. So investors have keen into that position. And also, look at the banking sector. There's still a lot of value. If you look at some of the results they've released thus far, and also the dividend they are paying. Remember forbearance some months ago. They were not supposed to pay till 2026, 2027.
Very true.
Today, all of them that paid interim dividend are actually going to pay. Now, you could say maybe the amount is not what they used to be. But again, one of them have even paid above what it used to pay. So we are good.
So, Idika, do you think the market is entering an overbought zone? And what's your take? You think we're entering an overbought zone? Because look at 40.7% year to date.
Well, if you look at it, if you look at the index, you might say that yes. But if you look at the individual stocks, like Mukhtar really mentioned, this is an earnings season. And people are really piling in, trying to take advantage in expectation of the profit or earnings coming in. So yes, if you look at it on that angle, maybe looking at it from the all share index, but I don't think it is like that. It's not all that going to be overboard. I think they still have to going to go up.
But you see the market entering a correction zone before the end of the year?
No, I don't think so. I don't think
I'm
so.
not going to say correction.
Yeah, I don't think so, because even if you look at there are equally some downsides on some stocks. Even in October, it's only a few of them. Like if you look at the agricultural sector, you can see Kumo and Presco, they are flat in October so far. The one that is driving that sector is Lalek and the FT and Cocoa, which has at least gained up to about 21%. If you go to the consumer goods sectors, I think PZ is leading there.
PZ
you see, like Mukhtar related, this thing is tied to sentiment because of the release of their results. They are doing very well. I think they have gained about 16% in October alone. So it's going to flow like that. Remember, we are still going to get the results are not even out. So by the time we start getting the results, and which we believe is going to be favorable, we are going to see more upside.
So let's talk about FCMB. Public offer, 16 billion ordinary shares, a price point of 10 naira per share. And it opened on the 2nd of, just a day after Independence Day, after Independence anniversary, and it's scheduled to close on the 6th of November. Is the 10 naira unit price, do you think that is attractive?
Well, like I said, that sector still has a lot catching up to do, trying to level up, because before now,
tier 2 now.
Yeah, tier two bank.
Tier 2 bank, yeah.
Before now, it used to be, I always tell investors, when you see FCMB moving, then you go and buy Fidelity. Fidelity is not moving, because Fidelity will definitely catch up with FCMB. Mm-hmm. And then sometimes you see Fidelity moving, FCMB is not moving. Go to FCMB. Very soon FCMB will move and almost close the gap. But now when you look at that gap, the gap between FCMB and Fidelity is wide. So definitely at 10 naira, FCMB becomes cheap for the public offer.
Very true.
Knowing that even the peers that were even behind, like Wema, we talked about Wema the last time we spoke on Monday. So when you look at that, what we call comparable analysis, Ndika knows all those comparable analysis, then you begin to look at what would drive me more value. Is it easier for FCMB to move from 10 naira to 15 to 20 naira? Definitely. Is it easier for Fidelity to move from 22 naira to 40 naira? It's not impossible, but it's going to be a really they have to be an out-of-the-world type of result to take it to that point. So that's why I think FCMB is a good buy, if actually you buy. Also, they have their own shortcomings when you look at history with FCMB, but I'm sure the current management team have promised investors that they will enjoy bumper adverts from FCMB. I think FCMB is one stock that I was bullish about as a young man. That was one of my first stock I bought at 4 naira in 2003 when they came for their first initial public offer.
At 4 naira?
At 4 naira. So definitely, if you look at that, where they are now, then that means there's a lot of potential for them to move further. With that, I can begin to say FCMB is a good buy for any investors. But yes, there will be their challenge, weary of share dilution. They have an outstanding unit of about 42 billion. Am I right, Indika?
Yeah.
And then added to that, you will have 50-something billion. So
like 58.
But when you look at the profit, moreover, some people look at FCMB as a bank. No, it's FCMB as a holding company. That is what people are not really looking at. People see FCMB as a bank. They are not looking at FCMB as a holding company. So for me, I think there's a lot of potential, especially when you look at the holding company structure.
So how do you think this public offer will affect their earnings per share and also their return on equity in near term?
Okay, when you increase your outstanding shares, definitely it will impact on earning per share.
Definitely.
Yeah, it will, because earning per share is just your profit divided by the outstanding shares.
True.
So I think in 2024, I think the earning per share was about 2.7 naira. Then for the first half of the year, it came to about 1.84 naira, which is about 62% of what they did in 2024. So now with the additional shares of about 16 billion, definitely it will impact on the earning per share. Provided, because there's always a caveat, provided if they don't grow their profit too much, which I believe that they will do that. Because if you look at their 5-year growth rate, compound annual growth rates, I think they have been growing on a compound annual rate of about 30%, which is still okay. So if they can sustain that momentum, yes, it will impact, but not much, because it depends on how well you grow your earnings.
Yeah, but some people are saying that the dilution risk would discourage non-participating shareholders. Do you think it will improve capitalization?
Look, dilution itself could be an advantage, that you are buying at the price you're buying. Then what's your investment strategy? Like Nika said, you talk about 30% over 5 years. So if you're a long-term investor, then in the short term, you could see dilution impacting on it. But in the long term, you also begin to see that the dilution is not impacting it that much. And again, I think I said 5 years group plan. Remember, the previous 5 years was FCMB as a bank sometimes. We are talking about FCMB as a holding structure. So I like making people understand that you are not just buying into the FCMB, you are buying into the group, the holding structure of the group. And what it means that they are into various financial services and others. So yes, it could have impact, like he said, in the short term. Okay. But I think in the long term, they will be good.
Yeah, and to add to that, when you are talking about when we're talking about companies, whether they are good or not, looking at their financials, it is not something we can really sit down here and do the whole analysis. So that's why I always recommend, it's always good to get in touch with your financial advisor, so that you can now assist. Even there are platforms that you can go and find out, because the most important thing I always say is the evaluation of that company, the valuation of the stock, whether it is undervalued, whether it is overvalued. And there are platforms, even I think even Nairametrics, if you go to followthemoney.ng, then that is where you can now see such information, subscribe, and you can get the information to actually know whether, like the issue of FCMB, whether it support what Mokhtar has said, whether it is a good buy. Then you now see the price targets, the valuation, whether it is overvalued, whether it is undervalued, and what are analysts saying about the price? What is the price target given to the FCMB? So it is very, very important that we should, at least investors should understand that, how to go about it.
So there's somebody watching, and it's very important. It's just off the cuff conversation, anyways. What's the difference between right issue and public offer?
Right issue is for existing shareholders. Public offer in the layman's for everybody. Am I right?
Yeah, sure. You're correct.
So you've heard.
Yeah, public offer is for everybody. No, normally, if you are listing, that's what we call IPO. That is initial public offer when you are coming, and that's what we call public offer. That is in addition to the one you have already on board. The right issue is a form of maybe let's give the shareholders the right first. You understand? Let's return to them. We are giving you the right to buy. That is where even the dilution, that's where it matters most. Because if you don't take your rights, definitely it will be diluted, because other people will not take it, and your own position will be diluted.
So you've heard it, but this is a public offer, not a right issue from FCMB. Let's move on to the final story. Bonds. We have 2 years, 3 years. It opened on the 6th of October and it's closing on the 10th of October. Now they're offering 14% per annum, and then 14.06 and then 15.06 respectively. So what's your take about the yields, 14 and 15% compared to prevailing Treasury bills rate? And I want you to also look at that. I'll juxtapose that with other fixed income asset yields. What's your take about the bonds?
Well, if ordinarily you can see that yield has gone down a little bit compared to what, and that brings us to what we said NPR the last time we were here. We said ordinarily you should see a lot of investors leaving the bond or the fixed income space into the equity market. We've just talked about an average all-share index of about 40%. But then again, some people look for safe havens. Safe havens is in the bond space. So when you look that yield compared to what you had before, but again, you have to also go back again and look at the interest rate at that when that other yield, you got the other yield of 15 to 14. So when you merge these together, then you are still seeing that you are making, you're not bad where you are, even if it's not beating inflation at the moment. But don't forget that we've been made to believe that we might get inflation about 14% before the end of this year, which I personally think is going to be a colossal tax to achieve that. But with the exchange rate where it is today, definitely it's not too much of something to about it. The bond market is good. I think for people that are looking for safe havens, is a good place to be.
So you think it's an investment suited for conservatives and those who are looking at hedging against inflation?
One is for suited for conservative hedging against inflation, then also for long time.
Let's look at it from this angle. When you talk of bonds, you have a government bond, you have corporate bond. Now, the one you are talking, I think, is the government bond. That is 2-year savings bond at 14%. The other one at what's the rate? I think
2 years at 14%.
The other one 3
years at
15%. Okay, it's just telling you that it's federal government that issuing this bond, and that is what we call risk-free assets. I mean, whatever happens, federal government will pay. So it's quite different from corporate bonds, and that's in investments. Looking at investment concepts, definitely, if you are investing in any other asset class, even bond, that particular bond, if it is a corporate bond, should give you a yield more than what this one is offering. Because that's what we call the risk premium. So you should be able to get the opportunity cost of investing because you know that this one will not go bad. But if you invest in maybe corporate bond, maybe the likelihood of you not getting the money is there. That is one part. Then again, if you compare this thing, the yield with Treasury bill, I know the last stop rate, 90 day was about 15. It was about 15%. Then 182, I think about 15.30%. Then I think 364 days was, I think is was 16.78%. You start wondering, these are short-term instruments. Now the Treasury bills are offering a higher rate than bonds. You understand? But though they are short instrument, this one is a 2-year instrument and the other one is a 3-year instrument. So for investors, in short, like you mentioned, they are for conservative investors because not only conservative investors, because people use it to stabilize the portfolio. If people use that to stabilize your portfolio, when you are creating a portfolio, you have to use the fixed income space to stabilize it. The one you are sure that you are likely to get, you match it against those volatile asset class like stock.
Come to the equities market.
Leave
this.
So that's the way it is.
I get that. But inflation, 20%, still above 20%.
Yeah, 20.12.
Do you think this is still do you think it's a really positive return? Don't you think?
No, it is not now. Muta has said it now. If you look at 14% against 20%, that's about negative return of about 6%. The other one is about 5%. But people still pile into it to use it to stabilize because the most important thing is your portfolio. You don't just invest in one particular asset class. So you use it to balance your portfolio. So depending on the type of investor, if you are a little bit you're old, maybe you are retired, it doesn't make sense investing in you putting all your money in equities because it's volatile.
And sometimes again, is the equity investors that are looking for good entry point.
Yeah.
And normally play the Treasury bill space, especially. They don't really play that bond space that much. They play the Treasury bill space because they are looking at a 90 days period.
Sure.
So they are looking at what will this equity be? Will it be a good entry point for me?
Yeah.
So sometimes when they've made so much in the equity market, they drag that draw out from the equity market to the Treasury bill space, get that 15%, and sometimes time one of them. Though they say timing is not so. Sometimes your timing could be wrong, but they're seeing a good entry point, maybe lower than where they exited before, and they come in. But again, those terminology, those keys will need to be managed next year from January when you have that capital gain tax.
Yeah,
So you must also be wary of just going in or coming out, because if you go out, you gotta pay that 30%.
Okay, to summarize all of this, especially with what my Able Mukhtar Mohammed has said, what he has said, and also Idi Kajar, they've said that don't put all your eggs in one basket. Don't put all your eggs in one basket. So that's just it in summary. And that's it from this episode of Market Watch. If you love to see this, watch us on Mondays and Wednesdays. That's when we have these conversations around the market. My name is Frank. I'll see you on the next one. Make sure you like, share, subscribe. Cheers.